Assalamu alaikum and welcome to the Oasis Focus on Finance show. I'm your host Shafiq Morton. Thanks for joining us as we continue with our tax series for the month of October. Should you wish to question us, send us a comment or a query, our SMS line and email address will be on screen during the show. In this evening's show, we are going to be having a look at the tax aspects of investment products. And we're going to be looking at three different categories. The first one is discretionary investment products. Don't worry, we will explain about that one. The second one is pre-retirement savings. And the third category is post-retirement products. Joining me from Oasis is Hugo Barnard, Internal Auditor, and Naweed Ashtiker, Wealth Manager. Gentlemen, assalamu alaikum. Good evening.
Wa alaikum salam, Shafiq.
Hugo, we're going to kick off with you. Discretionary investment products. First of all, what are they? And number two, how do they affect us in the tax regime?
Thank you, Shafiq. Discretionary investment products are the investment products that you invest your after-tax money in. There's a myriad of these products out in the market, but for purpose of this discussion, we're going to focus on collective investment schemes and insurance policies. If the viewers do have any other types of discretionary products like investments in shares or hedge funds or any of those products, we advise them to consult their tax advisors with regards to the tax aspects of those. Now, collective investment schemes is one of the most popular discretionary investment products around. Part of the reason for that is because the tax consequences of the tax aspects of collective investment schemes are fairly straightforward. If we look at the capital side of the investment, the money that you invest in your collective investment scheme is your capital contribution. For tax purposes, this is referred to as the base cost of your contribution. As a general rule, every time that you buy additional units or make additional contributions to your collective investment scheme, the weighted average base cost of your investment changes. If we look at an example, let's assume for a moment that I invest 100,000 Rand on 1 January 2015. I invested at 10 Rand a unit, which means I get 10,000 units. 6 months down the line, I make an additional investment of 10,000 Rand at, say, 10 Rand 50 a unit. So now I've got 10,000 Rand at 10 Rand a unit, or 10,000 units at 10 Rand a unit, and 10,000 Rand at 10 Rand 50 a unit. The weighted average base cost per unit is actually 10 Rand and 4 cents. The total number of units that I would have acquired is 10,952.38, to be specific. Now, if I apply that weighted average base cost per unit to that, the weighted average or base cost of my investment is actually 109,000 Rand 961, where the cash cost was 110,000. The difference is small, but you can see the impact of that.
Shafiq, if I can just add in on here, and in the previous shows we did touch on capital gains, on the disposal of investments and the implications thereof. Now, to calculate it simply, the capital gain can actually be calculated by simply deducting the market value or the proceeds on disposal of that investment less the base cost. Now, in the example that Hugo has just explained to us, the base cost is 109,961 Rand and 90 cents. So taking the 115,000, which is the market value, and subtracting it, the gain works out to 5,038 Rand and 10 cents. So that is the capital gain on disposal of that investment. Viewers should also bear in mind that any redemption of units within a collective investment scheme can bring about a capital gains tax implication, even when those units are disposed to settle any service fees. Now, the collective investment scheme management company will issue the unit holder with an IT3C certificate every year. And this certificate actually shows you what the base cost is and what the proceeds were of any disposal of units during that financial year. When it comes to the income distributions that you receive from the collective investment scheme, a flow-through principle applies. The collective investment scheme is the owner of the underlying shares or any other assets that it may hold. It then receives the income, it deducts any allowable deductions, and the net income is then distributed to the unit holder. The flow-through principle applies when, let's assume that a dividend is declared to the collective investment scheme. The income that is then distributed to the unit holder would then be a dividend. And if the income that is received is a profit, the distribution to the unit holder would also be a profit. Now, let's take a look at an example. if your dividends received is 1,000 Rand and your profits received is 500 Rand, the ratio of dividends to profits is 2 to 1. The total income is therefore 1,500 Rand. The allowable expenses, assuming it's 300 Rand, meaning the distributable income is now 1,200 Rand. The dividend distribution in the ratio of 2 to 1 means that the dividend is 800 and the profit is then 400. Now, as with the capital gains, the Collective Investment Scheme Management Company will issue an IT3B certificate. The IT3B certificate then shows you exactly what is dividend and what is profit. And it's very important that the investor captures these correctly because, for example, a dividend is not taxed further in the hands of the investor. So, it's very important that they actually capture these correctly.
We've just heard the magic word dividend, Hugo. Now, in previous programs, we did discuss something very briefly called dividends tax. Now, the client, they've got their money, and now we hear the word dividends tax. How does this apply? How do we deal with it?
As Naweed mentioned, when the management company distributes that income to you in the form of a dividend, they're obliged to withhold the dividends tax that is payable on that. Currently, the dividends tax is 15% for South African tax residents, but there are a number of exemptions and exclusions that might apply for reduced rates, etc. And we advise the viewers to contact their tax consultant if they believe if any of these reduced rates or exemptions might be applicable to them.
Now, let's look at something. It's a question that's come in from viewers. To me, it looks like a secret code. The first thing is IT3B and IT3C. What are we talking about?
Shafiq, the image on screen is that of an IT3B certificate issued by Oasis. As mentioned earlier, this certificate shows a breakdown of the income types that made up the distribution that you received from your fund. These classifications are in line with the specification issued by SARS. When you complete your tax return, you have to record the income in line with these categories. This will ensure that the correct treatment of the income in your return. The next image is that of the IT3C, which is the capital gain certificate. You will note that it shows the weighted average base cost, as discussed earlier, the proceeds, as well as the actual gain or loss. With all the calculations already done for you, all that you are left to do is simply record it correctly on your tax return. Please make sure that you retain these records in a safe place in case SARS queries it at some stage.
Thanks for clarifying that one, Naweed. Hugo, let's get back to you. Let's go to our second category, and that is pre-retirement savings. Sometimes one buys these, for example, from an insurance company, just as an example. But there's something further that comes out of this, and we hear the word endowment. How do we put all of this together?
Shafiq, an endowment is an insurance policy, and it's important that viewers take cognizance of the fact that the tax consequences associated with endowments, because the endowments are taxed in the policy itself. What this means is that the insurance company will have to account for the income tax and capital gains that accrue on the assets that underlie the policy. For policies that belong to individual policyholders, the tax rate at present is 30%. It's quite interesting that has remained at 30% since National Treasury has increased the marginal tax rates of individuals by 1 percentage point from the beginning of March this year. But let's not go down that route just now. We inform National Treasury of this, and they might be inspired to increase the rate in the policies.
All right, we're keeping quiet.
Yes. Since the taxes in respect of the insurance policies are paid in the policy itself, the amount that you get when the policy pays out is not taxed in your hands.
Now, let's have a look at retirement funds themselves. This is a huge market, isn't it? I mean, the Financial Services Board says something like 2 trillion rand held under management. Tell us more. I mean, it looks like as if retirement funds are huge.
Shafiq, the reality is that an overwhelming majority of people that are employed formally belong to some form of retirement fund. People that are self-employed belong to what is called the retirement annuity fund. Now, before we get stuck into the details, all retirement funds are governed by the Pension Fund Act of 1956, except some of the government funds, such as the GEPF. So the three main types of retirement funds that we do find is a pension fund, a provident fund, and a retirement annuity fund. Now, the biggest difference between a pension fund and a provident fund, well, there's two. The first one is that when we withdraw or when we retire from a provident fund, we can take out the entire amount. Unlike a pension fund where you are compelled to leave 2/3 and buy a pension annuity or annuitize it so that you receive a monthly income. The second difference is with a pension fund, when your contributions to a pension fund are tax deductible, where with a provident fund it's not. So currently as it stands, the greater of 1,750 Rand or 7.5% of your pension fund contribution can be deductible for tax purposes.
And let's hold that thought. You are watching the Oasis Focus on Finance show. We're talking about tax in the month of October. We're going to take a quick break. Of course, we'll be back right after this.